Good Wednesday morning, Market Chameleons. Everyone join us for the first time. Thanks for coming over to the Market Chameleon pre-market show, where we are live every trading day between 9 and 9:30, talking everything chameleon with this man, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Great. If there's anyone joining us from the IBKR webinar yesterday, thanks for checking us out this morning. Great job with that webinar yesterday, D.
Oh, thanks, Will. Thanks. That was a lot of fun.
Yeah, it was good. Now, and anyone who wants to check out that webinar, who is a regular on the show and maybe couldn't make it yesterday, you have to go to the IBKR website. That's Interactive Brokers website. Look at webinars. They keep a history of all 13. I think we've done 12 or 13 webinars. We've been doing it just over a year. So nice job, Dima. So what's going on? Let's actually, the disclaimer's there. Why don't we do the disclaimer before we get started?
Yeah. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent.
And that, let's get started. So let me share my screen first. What I'll do is talk a little bit about maybe like market valuations and stock valuations. I got email from one of our customers, Rob, who is on there every day talking about maybe that the market is not really pricing in a recession, and it's not pricing in some of the current risks that we have coming up in the marketplace. So we'll take a look at that, at least from my, I'll show you from my perspective. We'll take a look at a couple numbers and see if we have any questions. So if you guys have any questions, of course, put those in the live chat. And Will's reading them, Will's watching them, and he'll read it back to me. If you want to come on the show and ask the question live, we also put out a link to Zoom. If you click on that link on Zoom, it takes you over to Zoom. When you get there, click raise your hand. You don't have to turn on your video camera, but you can ask your question directly live. You can navigate us to where you're watching. But I guess the question is really, how far can the market go down, and some people were so used to like buying the dips, and you get a 10%. First it was a 10% dip, you bought every 10% dip, 20% dip, then you really buy it, that's the bottom. But the question is like, well, how far can we go down, like realistically, given some of the risks out there? And when we saw some bubbles burst, when the internet bubble burst, I think the Nasdaq was down like 75-80%. When the housing bubble burst, I think we're down like, I don't know, 60%, something like that. 70, it could go down a lot, and there is, and we'll talk about some of the differences here, because I think also the expectations is when we saw those markets go down, they've always kind of reversed and hit new highs again. It took a while. After the internet bubble, it takes a while. It's not always like a V shape, and it can become an L shape, and what an L shape looks like is it just kind of hits bottom and stays there for a long, long time. And what are the circumstances today? How are they different from before? It's also worth discussing, because some of those bullets that the Fed used historically, they may not be able to use those tools and get again, given the environment we're in, which is basically printing easy money, going zero, going to zero in the Fed interest rates, buying up assets. They might not be able to do that right now. They don't have those bullets. They're being forced to go the other way, right? They're being forced to go to the other way. And what's different is that we're kind of in this, I think we're in stagflation, right? We're going to get probably in a recession. We're going to be in a recession, and we got inflation, and the Fed's hands are tied. So but we'll take a look at just from some of the valuation metrics, and try to kind of get an idea like where we are, where we could potentially go. All right.
Perfect.
So before we do that, let's take a look at the pre-market report. And these are stocks that are trading in pre-market hours. And down here, we have a list of these. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. See that 101 stocks made our percentage gainers list, 54 in the decliners list. So right now, from that perspective, looks like it's more favorable towards the bullish side at the open. But I'm going to filter out this list to take a look at just S&P 500 stocks. This way we take out any small cap stocks, leveraged ETFs, closed-end funds, REITs, all those. We're going to take it out, just focus on S&P 500 stocks. And I'm going to use this filter here, an ETF, and drop it down. And I'm going to select SPY, S&P 500. And here we get a little bit of a different story now. It's kind of reversed. We have 7 on the percentage gainers list, 18 that made our percentage decliners list. So then from this perspective, that looks like it's more pressure towards the downside at the open. All right. So that's the pre-market report. And there are no questions here. Will, maybe then what I'll do is kind of start looking at some of these ratios and valuation models.
Perfect.
All right. Now, when we talk about, and I think one of the things was referenced as well, we have for a valuation model, like how do you value a stock, right? Like how do you know if this price is fair value, or if it's very cheap, or is it very expensive? And there's really no, when you're valuing the stock, it's hard because you're making assumptions. You have to create a model, you have to make assumptions and see what is a fair value to you. And not everybody's model or assumptions is going to be the same. That's why we have a competitive marketplace. People are competing, putting different inputs into their models, and the models could get very complicated. And for me, I don't really deal with valuation models of stocks as much as more options, pricing models, volatilities, and we focus more on like derivative stuff. I've worked though valuation models like ETFs would be an easy model to create because you could just recreate the NAV if you know all the components and weightings. You closed-end funds, certain things. Yes, I can. Stocks are a little bit harder, and the thing is that no, I don't think one person, unless you're very highly focused on the company and really know it well, you could build a very good model. But even a very good model is still assumptions, right? You still have to, and I'll give you examples of it. But so a simple thing that I do is look at some reference points and say, okay, I see Microsoft's here, but let me just see based on historical valuations, right? Like here's historically traded at this PE, in the last 3 years. So I have this here. Last 3 years traded at this PE, this price to book, price to sales, and relative to the market, it traded at this PE, at a premium, and so forth. So if I use those historicals and take the average, we could say like, okay, if it reverts to those averages, the implied value is 279. Right now it's 269. Let's look at a slight discount. So these are really quick reference points, starting points. Okay. We could also use a comparative model, which would say, okay, give me the future earnings, projected earnings for Microsoft versus future earnings for SPY. I could compare the two and say if they were equivalent, where would Microsoft, if I wanted the same return, where would Microsoft be priced at? And then I get an implied value versus market price. And here it shows me a different picture. So I'm not going to get too much right today into this. just because, again, like these are starting points, as a reference to say, okay, let me look at it deeper. All right. And I'll explain what I mean here. But when we look at kind of like evaluation, and I'm going to look at, let's take a look at SPY. Or here, I think I had SPY. So just the market in general, SPY. and any type of valuation to me model would be dynamic. It's reacting to other factors that play into the price of it. All right. And if we took it like from the basic point of view, I put up a notepad. How would you think of it as a commercial property, right? If I bought a commercial property and I paid $100,000, well, is it worth $100,000? Well, how much are you expecting to yield on it, right? And to me, if I could generate operating income of $10,000 per year, then to me that might be worth $100,000, right? So that would be a 10% return on invested dollars. Okay, so 10% yield. So think of it this way: $100,000 I paid for the property, I earned $10,000, right? That's my, let's say, rent. So my return per year is 10%, and that is how you kind of create. That's your starting point for valuing a property, right? Valuations. It's like, well, how much can if I'm buying it as an investment, right? It's either I'm expecting just to flip it because the price is just too low, like I don't know, piece of property, or I'm holding on to it and it's got to make me money. It's got to earn money for it to be worth it, or I'm going to put my money somewhere else. So, if the rent was $5,000 per year, right? If they said, if I'm looking at a 10% yield, I need at least a 10% yield. So if the rent is $5,000, right, then to me, this property might be worth only $50,000. Okay, so the first thing I'm looking at is how much is it yielding, and is the yield reasonable or not? Because to me, if it's not yielding anything, I have to have a good reason. Why would I invest in it? Right? Then I have to come up with a better reason. Because I think, well, the rents, it's 0% occupancy. Once I rent it out, I'll generate it. But there has to be a reason, right, why I would invest it. So let's take a look at the SPY, right? And the yield is basically the flip of a PE, right? You flip it and say, well, for every dollar I invest, how much am I yielding? And that's earnings. For every dollar I pay for a stock, how much is that stock going to earn? Because if I buy the entire company, I'm entitled to all those earnings, right? So okay, I only own one share, so I'm entitled to one share's worth of earnings. But if I buy all of it, I'm entitled to those earnings. So how much are those earnings yielding based on what the price I'm paying? So let's take a look at SPY first. And I like to use operating income, not just net income, because net income would include any type of investments you do that goes into income. So if you bought Bitcoin and flipped it, that goes into income. You did investments that aren't related to your normal days of operation, they'll go into your income. So the operating income just looks at income coming from your core business, right? So if you're in the business of selling advertising, then how much income did you make from there? If you're in the business of selling electric vehicles, how much income did you make from there? It takes out everything else. So in SPY, right now, here is the operating yield, about 5.5%. In other words, if everything stayed the same, right, from last year, and earnings didn't go down, earnings didn't go up, the stock price remained the same. I bought the stock today and earned everything exactly the same as I did last year, then I'm expected to yield 5.5%. Like I would, if I bought all the stocks, S&P 500 stocks. And is that reasonable or not reasonable? Right? And here's the 3-year average. Here's the 5-year average. So this also, think of it, it has to be a relative value, right? So maybe that's reasonable when interest rates are 0% or 0.25%, right? Because if I not making anything on my money in the bank, and I'm not, there's no risk-free way of making, more than 0.25% or 0.5%, maybe 5.5% is reasonable. In addition to that, what do you do when you're renting out, right? Sometimes if you think that the rents will not go up, you might demand more, right? 10%. But if you think that, hey, the rents are going to grow every year because this area is hot, there's going to be growth, there's not enough, there's no more land to build, but the population is growing, incomes are growing here, you might be willing to pay more and take in less rent at the start, thinking that eventually this is going to grow and you're going to, yield way more than that. So 2 things going on here right now at 5.5% that we have to consider. If the risk-free rate, like they say, by the end of the year goes to 3.5%, I don't think this is sustainable. I don't think people will continuously invest in the market for 5.5% if you're getting a risk-free rate of 3.5%. That doesn't make sense to me. That means that the market will have to go down way more. Right now, I think we're pricing in that perhaps that we're in a recession and the Fed is going to have to halt somewhere around here. But I don't think that it's pricing in a 3.5% risk-free rate, because that doesn't make sense to me. You're already way too close. Those margins are way too close. 3.5% versus 5.5% to me does not make sense. I don't think it's sustainable.
Yeah, well, the Fed to me is at least they should be more fearful of inflation than a recession, right?
Right.
I mean, the inflation number just came out today, and it was either higher than they were hoping that it had come in a little, but it was over 8%. It's
right.
And anything you read from economists to get inflation under control, they're going to have to get it over the inflation rate, right? So they're still just dipping their toes in the water, the Fed.
They're dipping. We're not even halfway to the 3.5. We're not even halfway to the 2.5%, which is neutral. So that's concerning. But the other thing that's going to weigh on this, right? It's 5.5% because revenues have traditionally grown in S&P 500, right? So here's the 3-year growth rate, 5-year growth rate last year, right? So it's not 5.5% constant. If revenues are growing, and typically I think operating income is about here. Let me see if I can find it.
Well, Rob asks an interesting question. He says as the market goes down, its yield should increase, correct? And then he asks, he says unless companies start losing money and cutting dividends. And into a recession, that could definitely happen, right? Cash becomes king. And
keep in mind, this isn't a dividend. This isn't a dividend yield. This is earned. So company can retain earnings, not paid out as dividends. They could reinvest it, but this is operating earnings. But and that's the next thing I'm going to get to. But look, typically, I think that the operating margins in SPY is around here, like 11%, maybe 10%. Like it went up a little bit, 12.7%. So what you're saying is that for every dollar in revenue, their operating margin is about, let's call it 11%. So if revenue goes up, right, your operating margins as a percentage, as a percentage of your revenue, those will go up as well. So then a couple of things about this here, what's going on. First of all, operating margins could start getting squeezed because operating margins are based on your expenses as well. So you're making revenue, but you have to reduce your expenses from the revenue to get profits. Our operating margins could start getting squeezed because of inflation. You could have wage inflation. You could have input price inflation. So unless you're passing it on, and I don't think all the companies can pass on, I don't believe that. I don't think that every company has that kind of pricing pressure, that they could just pass on any cost. That's not realistic. So I think these operating margins are going to get pressured. I believe that. I think we're gonna start seeing that maybe in like another quarter or so. So that's the second thing right now we're talking about that's going to get squeezed. The third is that this 5.5%, these are based on increasing revenues. The revenues are going up. In a recession, that's not going to happen, right? So if we fall into a recession, is Facebook is Facebook recession proof? Are they going to be able to sell the same amount of ad? They might be able to maintain the same amount of free users, but are they going to? But that's not what's generating them revenue. Are they going to be able to, grow their ad revenue, charge the same amount for ad revenue? Because those companies are going to start feeling recession pressures too, right? They're going to feel it. And how much is, for example, Facebook, they generate a lot of ad revenue from local businesses, right? A lot of them from new ventures. But it's not just Facebook. I'm just saying in general, it could be Google. All of them are going to start seeing pressures in a recession on revenue growth, and we could have revenue declines, right? This could not only not grow, not only could it go zero, we could start seeing revenue declines. So you have all these, and by the way, interest rates going up are going to impact some of the interest rates alone impact, right, your revenue, because a lot of the companies that are in the S&P 500 rely on credit, borrowing, there are REITs in there, financial, there's stuff in there that do rely on borrowing costs. So these are, how do you model this? It's, you have to give probabilities, right? That's the only thing. It's like, well, there's a probability we're going into recession here. And if that happens, we could recalculate. There's no revenue growth for 3 years, maybe, or very small. The risk-free rate might have to stay at 3.5%. And if the risk rate is 3.5%, your operating yield might have to, this might have to climb, I don't know, to 7%, right? 5.5% is not enough to any longer if you're at the risk-free rate at 3.5%. So you give it a probability there, reprice it, right? And say, that's where the SPY would be, right? Much lower, just like I did over here, right? Well, if I'm demanding 10% because I want to go whatever above the risk-free rate, well, what is the risk-free rate? Well, I got to add that. And then what is the rent I'm expecting to make? And then I give it a valuation. All right. So yeah, I'm not going to go like full detail into models and stuff because I think that every model is different. For example, in airline, it's, there are inputs in there that are changing frequently, like maybe oil prices. How much do oil prices impact, their margins? How much does higher ticket prices impact their sales and so forth? So when you start feeding it, and it's a relative model as well, right? Well, if the S&P 500 is here, then the stock should be here because I could always move out of a stock and go back into the S&P 500, which, offers a better yield. So it's dynamic, and there are a lot of inputs in there to drive that. So these are reference points that I gave you that were somewhat dynamic, but model could get very complicated. But I'll tell you what I don't trust. Like I just picked up Yahoo Finance, right? And here and not against Yahoo Finance, but I use it all the time. But here's what happens with analysts. They give you a target price, right? $301, and they'll just stay there, right? Here, Facebook's 200. They'll stay here for a while, and when they feel like the stock has moved far enough from it, they'll adjust it, right? What you'll see is now we're at 250, right? Here's Coinbase. And to me, that's not even a real model, because a real model, it has to be adjusting, where are interest rates, how does this affect interest rates? Where's the rest of the market? Here's Coinbase, 263, right? And you'll see it just sit there. And then finally the analyst will say, oh, okay, well, it's just too far away.
You're saying I can't cash in that 263?
Yeah, there's no way to cash in. A lot of people ask me, well, where are these analysts' ratings? Where are these target prices? If you've ever dealt with financial models and look, now there are analysts there that are, that are good. I'm not saying there are analysts out there that are good, but they're not selling their research. It's usually within a hedge fund or within the bank itself, but they're not issuing these here. To me, I mean, like, it's almost like I think that it should stop. Like, honestly, I think it should stop, because it's not realistic. Those aren't real models. Those are like, just, you're throwing out a number, and what's the explanation? Like, why is this too, like, show me how you got there. Like, show me the model, show me like how you got there. What is the explanation for it? Because, and that's why I don't even, like, we get vendors all the time trying to sell us analyst ratings and target prices. And on the other side, I have customers saying it, and I just can't do it because I look at it and I'm like, and I know that's not how it works, like this. And by the way, you could get it, you could go to Yahoo Finance because they put it out there. Yeah, this isn't Yahoo's, target price. They're getting it from analysts, right? And when you're saying, well, how did you, well, I don't know, let's see. And what they'll do is, like, as the stock price goes up, they're like, okay, now let's raise it. And like, okay, what is the explanation? Like, how did you get to it? There are a couple ways you could get to it, right? You could take the breakup value, book value, right? And just go, okay, book
Well,
value
that'd be significantly lower.
Yeah, you could take book value, and then you could add earnings to it, earnings growth, right? There are sophisticated models, like, Bill Ackman, what did he say? He got out of Netflix because he couldn't model it anymore. He's like, we can't get probabilities of revenues going up or down or earnings, so he got out of it, right? But they're using models and inputs and trying to say, like, here's our probabilities. If this happens, we think that it's going to generate I need a 6% yield. If this happens, the stock's worth $100. If there's a recession and earnings fall here to generate that 6% yield, then I need, then the stock is $50. If revenues grow, then the stock is 120. The probability of it, is 80%, 20%, or 80, 10, and 10, and then you come up with a fair value and a distribution of prices. So really, you need a distribution of prices and probabilities, but you need to be able to model it. And look, by the way, I think that's Warren Buffett started, things used to trade below book value, right? So he didn't even care. He was like, well, if the breakup value is $100 per share and the stock is trading at $50 and the stock in the company makes money, I'm just going to buy it, right? It's like, it's just because its liquidation is higher. And that's how I think he started out. He was just buying it below book value. As long as the company made money, it was a good deal. Now everything's above book value, and now there's all these types of projections.
Well, I mean, it's amazing that, where coin price is, that hasn't adjusted that 1 year estimate. I mean, I look at that and I think I envision seeing under $10 a share before it's ever 200 again. I mean, it could, if it survives this, it may in its lifetime.
This is
200.
Yeah, exactly. So that's what I'm saying. Like, to me, a model is adjusting. It's dynamic. It's adjusting because there's always new information, and there are inputs in there that, even something like interest rates, it's got to be, like an option pricing model is adjusting, right? Like interest rates, you put in dividends, you put in volatility. So,
I mean, let's be honest, Coinbase may be under $10 today. Look at this thing.
Yeah, I mean, it's yeah. So, and it's hard to, Coinbase would be a hard thing to price. That's why you think it could be all over. That's the volatility, because the distribution of prices based on projections could be very wide. It could be like from $10 to $100, and how do you give these probabilities, and what is a fair value? So there might be a 10% chance it goes to $10 if they don't, if cryptos, whatever, go down another 50%. But it's very tough, and this is the reason, I don't, from my experience, I just don't even. Now, there are banks out there who have very good analysts, and there are hedge funds who talk to these analysts, and most of the time they look at it like, why did you project this revenue? Why did you project, this earnings? And sometimes they give good explanations, and those hedge funds would adjust their own models. But like, that's why I don't even here. Let's see. Is this analyst? So here, number of ratings. This is Coinbase, right? So, here are their estimates. How do they come up with these? It's like they don't explain it. So that's why I'm like, how do you come up with, $8 billion in revenue? You could see, look at their estimates. These aren't, it's not one analyst. Look, 23 analysts, and you could see they're $8 billion, sales growth 21%. How do they come up with this? And why isn't it changing, like, to reality? They're kind of holding it there. And to me, it's dynamic, right? If why isn't this changing if we've seen cryptocurrencies drop by 50% and volumes dropping off and all this? Why isn't this like changing? To me, that makes no sense. Huh? Yeah, it doesn't make. Yeah, it should be changing real time. So when I'm seeing this, like, that's why I'm like, okay, then you're just like throwing out a number there, and you're not changing it because nobody else is. Right? There's 23 analysts, and they're kind of all paying attention. Well, if he's not doing it, I'm not doing it. And where's the explanation? Like, show me the explanation. And if you're not doing it, then to me, okay, then I'm putting zero weight on it. That's my opinion. I'm putting zero weight on it. That's how I look at it. So
we're 4 minutes into the opening. Great job, buddy.
All right, everyone. Thanks for joining. Stay safe out there.